Okay, let's dive in. Picture this. You've navigated the crypto market, maybe caught a huge bull run, and wow, you're sitting on some serious gains.
Yeah, potentially life-changing money. It's the dream scenario for anyone in crypto, right?
Absolutely. But then comes the flip side. These sources we've got really hammer home.
Taxes. Governments see those gains and they definitely want a piece of the action.
We're talking significant percentages. Like the sources mention places like the UK, Canada.
Hmm.
They could be looking at 20%, 30%, maybe even 50% or more.
It's a huge chunk, and honestly, that's not even the only headache.
Right. Because even after you figure out the tax, just getting that money into, a regular bank account can be a whole other battle.
It really can. Banks are notoriously cautious about large crypto deposits. Sources mention accounts getting flagged, sometimes even closed down.
So you have the wealth on paper, but actually accessing it
Hmm.
legally without losing half to taxes and avoiding banking nightmares. That's the real challenge.
And that's exactly the puzzle these sources, various expert takes, videos, analyses are trying to help solve.
How to legally navigate it all. Aiming for that zero tax outcome, usually the sources say through moving somewhere else and setting things up right.
Precisely. So our mission today is to unpack all of this. We'll dig into these sources, pull out the key locations they recommend, the strategies, the requirements.
And the pitfalls too, right? What could go wrong? We need to understand what's really involved, according to these experts, in trying to legally cash out crypto tax-free.
Okay, so where do you even start? The absolute first step, based on everything we've seen, is residency, tax residency.
You have to become a tax resident somewhere that doesn't tax crypto gains.
Exactly. And critically, you need to do that before you actually sell or cash out, before the taxable event happens.
Which almost always means you have to, officially stop being a tax resident in your current high-tax country.
Yes. It's about where the government considers your home base for tax purposes when you hit that sell button.
Okay. And when you look at the places these sources point to, one name keeps popping up. Dubai. The UAE.
It's definitely a top recommendation across the board, and there are several reasons why.
What are they highlighting?
Well, first, it's generally seen as very crypto-friendly. The government's even promoting digital assets. Plus, there's a welcoming attitude towards wealth, which isn't always the case elsewhere.
Good point. High safety, good quality of life, too, they mention.
Right. But the absolute headline grabber, 0% personal income tax. And crucially for this conversation, 0% capital gains tax.
0%. Okay. And how fast can you make that move? The sources talk about speed.
Yeah, surprisingly fast, actually. Some mention you could potentially get residency sorted in like 2 weeks, maybe under 30 days in some cases.
Oh,
Often the simplest way is setting up a basic company there and then basically employing yourself through it.
okay. And for people with more significant assets?
There's the golden visa option.
Yeah.
That usually involves a larger investment, something like 2 million dirhams, which is roughly 550,000 US dollars.
Invested in what?
Could be real estate or even just deposited in a UAE bank. That
Huh.
gets you a 10-year visa, so more long-term stability.
Got it. But there's a big but here for U.S. listeners, isn't there?
Huge one. Absolute critical. If you're a U.S. citizen, the U.S. government taxes your worldwide income, period. Doesn't matter where you live.
So moving to Dubai doesn't help U.S. citizens escape U.S. taxes.
Nope. Not unless you take the pretty drastic step of renouncing your citizenship, or there's a mention of specific U.S. territories like Puerto Rico having different rules, but the sources don't really go deep on that. It's noted as a rare exception.
Okay, so this strategy is mainly for people looking to leave high-tax places like, say, the U.K., Canada, Australia, Europe.
Exactly, for non-U.S. persons. And the key is you must successfully sever your tax residency in your home country to actually benefit from the UAE's 0% tax on those gains.
Right, makes sense. Now, Dubai seems like the main focus, but Thailand also gets mentioned quite a bit, sort of a plan B.
Yeah, or even a complementary option, maybe somewhere to spend the summers when Dubai gets really hot. Thailand comes up as a strategic alternative.
And visa options there. I think I saw a few mentioned.
There are several. The Thai Elite Visa, which involves paying a fee, starts around 25K for 5 years. There's a newer digital nomad visa for remote workers.
But the one the sources highlight for tax reasons is different.
Yes, the long-term resident visa, or LTR, this one's geared towards wealthier individuals.
What are the requirements for that LTR?
Generally, you need a decent net worth, like over $1 million US, and you need to invest about $500,000 into Thailand, could be bonds, bank deposits, real estate.
Okay, quite a commitment. What's the tax angle?
This is where it gets interesting and a bit nuanced based on the sources. The general rule for tax residents in Thailand, meaning you spend 180 days or more there, is that foreign income is taxable.
Including crypto games made outside Thailand.
Yes, but only in the tax year you actually bring the money into Thailand. Remit it.
Okay, so if you make gains abroad and leave the money there, no Thai tax. But if you bring it in, you pay.
Generally, yes, under the standard rules. They tax the game portion you remit, using methods like FIFO to calculate it. Rates can go up to 35%.
So how does the LTR visa change things?
According to the sources citing the LTR program details, it grants a specific tax exemption on foreign-sourced income, even if you remit it to Thailand.
An exemption even if you bring it in.
Yes, though one source specifies this might apply mainly if the income is remitted in the following tax year after it was earned abroad. So the timing of remittance seems key for the LTR exemption. It's a potentially powerful difference from the general rule.
That's a detail worth noting. But can the Thai authorities actually track the money coming in?
Oh, definitely. Thailand participates in the Common Reporting Standard CRS.
The automatic information exchange between countries.
Exactly. They get financial data from over 120 countries. So if large sums land in your Thai bank account from overseas, they likely know about it and can ask questions. Compliance is taken seriously.
And if you don't comply?
The sources mention pretty stiff penalties, fines potentially up to 200% of the tax owed, plus interest, maybe even jail time in serious cases. So understanding the rules, especially around the LTR if you go that route, is crucial.
Okay, so Dubai and Thailand are the main ones discussed. But the sources touch on other places too, right?
Yeah, a few others pop up. In Central America, for instance.
Like where?
El Salvador gets a mention. 0% tax. Bitcoin is legal tender everywhere. Described as a bit adventurous.
And Costa Rica.
Costa Rica, too. It has a territorial tax system, meaning foreign income, like crypto games made outside Costa Rica, generally isn't taxed there. Plus, points for healthcare and nature.
Then you have the more traditional, maybe pricier island options.
Right. Think Cayman Islands, the Bahamas. They offer that tax-free lifestyle, but residency usually requires a pretty hefty investment, often $1 million or more, typically in real estate.
Any caveats there?
Well, one source notes the Bahamas is getting a lot of scrutiny lately, likely because of the whole FTX situation. So banking and compliance might be more complex there now.
Okay. What about something maybe less mainstream, lower investment, Vanuatu?
Vanuatu is mentioned. It's remote, yes. Land can be cheap, like 20 tayo starting. But challenges like healthcare and typhoons are noted.
But the tax situation?
0% crypto tax. And it also offers citizenship by investment for around $130,000, which is relatively affordable on that scale.
Interesting. Let's hop over to Europe. Malta comes up.
Malta's an intriguing one, especially its non-domicile regime.
How does that work for crypto?
Okay, so if you're a non-dom resident, you're generally taxed on income earned in Malta, and on foreign income you bring into Malta remit, usually at a flat 15%.
Right.
But, and this is key according to the sources, capital gains from selling assets like crypto or stocks are specifically not taxed, even if you bring those gains into Malta.
Wow. Okay, so gains are treated differently from other income.
Exactly. It's a specific carve-out. There is a minimum annual tax, though, about $5,000, even if you remit nothing.
And residency requirements.
You typically need to be there 183 plus days, rent or buy property meeting certain thresholds like 9K plus annual rent, show you're financially independent, and have health insurance. There are higher tiers for permanent residency or citizenship, too.
One source mentioned something about UK residents and Malta.
Yeah, potentially using the UK-Malta tax treaty or maybe setting up structures there like trusts to manage UK tax exposure. Definitely needs professional advice, though.
Makes sense. Then for the super wealthy, Switzerland and Singapore.
Yeah, these are top tier, requiring serious wealth and investment, millions.
What's the Swiss angle?
Switzerland offers a potential path to very low or zero tax through what's called a lump sum tax agreement. Basically, you negotiate a fixed, large annual payment, maybe 500K or more, and then your actual income and gains beyond that aren't taxed further. Plus, you get the Swiss quality of life, healthcare, stability.
In Singapore.
Also mentioned for 0% crypto tax. Highly developed, great infrastructure. But the sources stress that getting residency or citizenship is tough. You have to genuinely commit to living there and investing significantly in the Singaporean economy, not just park your portfolio there.
Okay. Any other places mentioned? Maybe less enthusiastically.
A couple. Malaysia comes up theoretically 0% crypto tax, cheap, but described by one source as maybe a boring Thailand and having some messy immigration program changes recently.
And Portugal. It used to be popular.
Keyword, used to be. The sources warn Portugal is actually adding crypto taxes now, starting with short-term gains, and they're phasing out popular programs like the non-habitual resident NHR status and the golden visa.
So not tax-free anymore. Or at least the future is uncertain.
Pretty much. Maybe a very short window for some EU folks on long-term gains currently, but the message is clear. It's changing fast. Belarus also got a brief mention, apparently favorable to crypto investors. Inexpensive Minsk, but yeah, requires an open mind given the political context.
Okay, so establishing that tax residency before you sell is step one. But just getting the new ID card isn't the end of the story, is it?
Not even close. The sources really emphasize this. You need to think about structures like companies or trusts, and maybe the biggest piece, how you'll actually deal with banks.
Ah, yes, the banking challenge. You mentioned that earlier.
It's where a lot of these plans apparently stumble or hit a wall. Setting up entities isn't just about fancy structuring. It can be crucial for asset protection and, really importantly, for making interactions with banks smoother when you try to cash out.
What kind of entities do the sources suggest?
A few examples come up. One source calls a U.S. LLC a no-brainer for non-U.S. persons, provided it's set up correctly. No U.S. business, no U.S. tax connection.
Why an LLC?
It can offer anonymity, potentially no U.S. tax or filing if it only has foreign income, and apparently it's useful for opening accounts at major crypto exchanges like Kraken, sometimes even bank accounts.
And for pure protection.
Things like UAE foundations and the DIFC or ADGM free zones or even Cook Islands trusts are mentioned for holding assets securely, separating them from you personally.
What if you're actually running a crypto business, not just investing?
The sources mention setting up licensed crypto companies. Places like Lithuania, Georgia, Canada, El Salvador, Switzerland, Hong Kong are noted as having frameworks for this. Lithuania is mentioned as an example for getting exchange or wallet licenses. Interestingly, they say getting licensed in the UAE for crypto operations is currently a bit more complex.
Okay, but let's circle back hard on the banking issue. You said it's maybe the biggest hurdle.
It's a constant theme, yeah. Even in places like the UAE that are generally pro-crypto, the actual banks on the ground are often very risk-averse.
Why is that?
Global pressure. AML, anti-money laundering rules, KYC, know your customer. Banks are terrified of facilitating illicit flows, especially after things like the UAE being on that FATF gray list for a while, even though they're off it now. It led to more scrutiny, not less.
So they don't like big, sudden crypto cash outs.
Generally, no. Especially if the account is new or has no history. They don't want to be seen as just a quick on-ramp or off-ramp for crypto. They want to see legitimate, ongoing banking relationships.
So how do you find a bank that will work?
The sources suggest looking for banks used to handling international wealth, offshore structures, maybe non-traditional asset sources. Some Swiss private banks get mentioned, Bank P, Bank Frey, but they usually want very high minimums.
How high?
Like one source mentioned 1 million Swiss francs minimum, another said $5 million for Bank P. So not for everyone. In Asia, maybe banks like DBS, UOB, or Bangkok Bank might be options.
And in the UAE itself?
Here.
ADCB, Emirates MBD.
They're mentioned, yeah. You can often link them to exchanges like Binance for smaller withdrawals, but the feeling from the sources is they might be less comfortable with really large, direct crypto to fiat conversions compared to, say, the big Swiss or Asian private banks. Building history first is key.
Any surprises?
Yeah.
Like non-traditional options?
One source briefly mentioned that even services like Wise can sometimes work if you approach it right, but it's definitely not positioned as the main strategy for serious amounts. Okay, so let's say you've done the residency, maybe got an entity, found a potential bank. How do you actually get the cash? What methods are discussed?
The obvious one seems like just using an exchange, right?
That's the standard path. Crypto to exchange, sell for fiat, withdraw to your bank account linked with your new residency ID, like your Emirates ID.
But the risk is the bank flags the big incoming transfer.
Exactly. If it's a large amount landing in a relatively inactive account, it triggers alarms. You need to manage that process carefully, maybe have established some transaction history first.
What about peer-to-peer or P2P?
That's another option, especially visible in places like Dubai. You use either physical exchange shops or online platforms to trade crypto directly with another person or service for cash or a bank wire.
Is that better for large amounts?
Sometimes, the sources suggest, But, and this is crucial, it absolutely doesn't bypass regulations. You still need solid proof of where the funds came from for AML checks. It's not an under-the-radar method.
Okay. Then there's the idea of just buying stuff directly with crypto. Cars, watches, real estate.
Yeah, that sounds attractive, doesn't it? And sources say it can be relatively straightforward in places like the UAE or the Maldives to find vendors willing to accept crypto directly.
But is it a loophole?
Definitely not, according to the sources. Tax authorities, like Thailand's, for example, see that as realizing your gain. It's effectively cashing out just into an asset instead of currency. It's still subject to AML, and it doesn't magically avoid tax if you're resident somewhere that taxes those gains or remittances.
What about layering? Buy crypto, buy a car, sell the car, get cash.
One source explicitly warns against that if the intention is to hide the source. They called that kind of layering potential financial fraud, so not advisable.
Okay. And brokers. Usually professional service.
Mentioned as an option, especially in the UAE where licensed crypto brokers exist, but comes with a huge warning about scams. If you go this route, extreme due diligence is needed. Only work with properly certified, licensed brokers.
It sounds like across all these methods, the big message is legitimacy matters.
Yeah,
A lot.
that's the core takeaway, really. The idea of just quietly showing up, cashing out millions, and leaving without anyone noticing, that's probably fantasy, especially now.
Why especially now?
Global coordination. Things like CRS mean government shared data. FATF recommendations push countries to tighten AML KYC. Authorities are getting stricter everywhere. You have to genuinely establish residency, live there, have real financial substance, and document everything meticulously.
Document everything, like transaction records.
Absolutely. Keep records of all buys, sells, transfers. The sources on Thailand mention needing records going back 5 years for audits. You need to prove the legitimate source of your wealth and be aware of rules like the UK's potential 5-year clawback if you move back too soon.
So planning is everything, and trying to cut corners is risky.
Extremely risky.
Okay, so let's try and wrap this up. If you had to distill the main insights from these sources on this whole crypto tax-free relocation idea, what would they be?
I'd say first, it's complex and always changing. No easy button. Second, establishing legitimate tax residency somewhere favorable before you sell is absolutely fundamental. Third, think about entities for protection and, crucially, for banking access.
And banking itself is the big pain point.
Huge pain point. Be prepared for hurdles. Finding the right bank takes effort, often requires high minimums, and you need to build a relationship. Don't just show up expecting them to handle millions in crypto overnight.
Understand the cash-out methods aren't loopholes.
Right. P2P, buying assets, they still involve scrutiny, AML checks. And finally, remember, regulations are tightening globally. Transparency, meticulous records, and getting professional advice tailored to your specific situation are absolutely essential. Don't try to DIY this based on a few articles.
That's a really solid summary of what these sources are telling us, which leads to maybe one final thought for you, our listener, to chew on.
As governments keep getting better at tracking money through things like CRS, and as they keep writing new rules for digital assets, how do you, as an individual, balance that understandable desire for financial freedom, for optimizing your taxes, with this inevitable global push towards more transparency and more compliance in the years ahead?